Hey, good afternoon, everyone. And I'm talking to you from Lucky Memorial here at Houghton College on a lightly snow-covered quad. As I look out the window, I see both green and white. We're thankful that you are here for our third installment of Ask the Experts. And this is just an opportunity to invite some of the folks that are alumni or friends of the college whom we consider as experts in the field of financial and estate planning to dig into some topics that we think might be helpful to our alumni and friends. So today we're thrilled that Dick Hallberg is here and will share some of his expertise, and members of our advancement team will step in and try to be helpful in the course of the conversation too. And one of the things that we want this to do is to be a really informal conversation. There is plenty to be able to talk about. We want you to ask questions at any time. So feel free to, I think there's a hand raising emoji that you can hit. You can type a question into the chat to Dan or I, who are the co-hosts, or simply just unmute yourselves and feel free to ask the question when you have the opportunity. I would encourage you or be thoughtful of muting yourself, possibly when someone else is talking, just to try to avoid as much of the background noise as well. We will, as I just mentioned, to some of you, be recording this. We'll be posting it to our Advancement YouTube channel tomorrow so that others can enjoy. And if you want to refer to it, you can do that as well. So at this time, I'm just going to introduce Dan Noyes, who serves as a Regional Director of Development here for the Office of Advancement, and he will introduce our expert for the day. Thank you.
Welcome. I'm glad you're all here. And one of the things I want to do before I introduce Dick Hallberg, for those of you who don't already know him, I want to give our team a chance to introduce themselves so that you know who they are as they chime in throughout the talk. So as Carl said, I'm Dan Noyes. I'm a 93 grad of Houghton, and I am a regional director of development, which means I have, those of us who are regional directors of development, it means we have regions around the country that we are able to visit. I am sacrificing and taking a trip to Arizona later this week. That's one of the things I do for Houghton. So why don't, Caleb, why don't we have you introduce yourself, and then we'll go around and have everyone else who is a member of the team.
Thanks. I'm Caleb Smith. I'm a recent class of 19 grad, and I joined the Office of Advancement as their gift accountant and legacy giving specialist. That means I work to record and process gifts, make sure that everything's going to the right place, and work with John and the team to process and record some of the larger gifts like charitable and annuities and trusts.
I'm John Oden. I'm a class of 2008 grad, and I serve as the Executive Director of Advancement Services and Operations, so manage most of the things behind the scenes with Caleb.
I'm Skip Lord. My niche area is National Director of Athletics Engagement, but I also do regional director, a major gift officer kind of work as well. So pleased to be part of the team.
And I realized I never actually introduced myself. My name's Carl Sisson, and I'm privileged to serve as the Vice President for Advancement and External Engagement here at Houghton.
And we are privileged to have Dick Hallberg joining us for this and agreed to help us out. Dick is a 71 grad of Houghton, but is best known for generations of business students from his time teaching at Houghton. He'll tell you a little bit about what he's done in terms of being a financial advisor, financial planner. One of the things that I've encountered the most are students who have taken the investment class at Houghton, wherein they invest somewhere in the neighborhood of $300,000 of our endowment in the stock market. And Dick, for many, many years, led that class, helping students to analyze information, make good decisions about what vehicles they were going to purchase. And I've run into so many alumni who still talk about that class and how it's impacted not only their financial decision making, but their decision making outside of the world of finance. And so, and Dick has served in a number of other roles during his time at Houghton. I think he did some soccer coaching, and I know you played a lot of racquetball too when you were at Houghton as well, Dick, seeing you over in the Nielsen Center a few times. But we're grateful to have Professor Emeritus Dick Hallberg with us. So Dick, welcome, and why don't you tell us a little bit about your experience, your philosophy of investing, and basically a little bit more about what you're doing now.
Well, like lots of folks, my career kind of evolved over time. I started in the insurance industry right out of college, specializing in life and health insurance. That didn't last too long, and I jumped into graduate school where I focused on finance and investment management. And that laid the foundation for my teaching career, but also tied in very nicely with as my interest in financial planning developed, which came a little later and was an outgrowth of helping some people in the Houghton area. And then I finally decided to do some formal study in the area of financial planning, ultimately leading to receiving my certification in financial planning. And all of that complemented my teaching very nicely, but also gave me an opportunity to serve, I guess, to serve what I refer to as the middle market in financial planning. People that are often underserved, and that's where I have focused most of my financial planning work. And I have tried to emphasize more of a coaching role in financial planning. I don't want clients to become dependent upon me, but I want to help them learn how to do as much of it themselves as they're able to, and then support them and answer questions as necessary. I also believe strongly in our responsibility to be good managers of our financial assets and the assets that are entrusted to us. And so I want to help my clients do that as well.
Thanks, Dick. And you know, as we're here to talk about, you know, income-bearing gifts and investments, can you talk to us a little bit about some of the reasons and some of the benefits that individuals might seek out an opportunity to make a gift like an annuity or a trust that provides them in some financial income?
Sure. One of the things we often hear today, or one of the acronyms that I hear on TV and that I read in magazines and newspapers and so forth, is the acronym FOMO. And if you're not familiar with it, it means fear of missing out. As a financial planner, and the work that I've done with clients in retirement planning, usually the appropriate acronym there is FORO, which is FORO, which means fear of running out. And most retirees are trying to make sure, or potential retirees, I guess that includes all of us, we're trying to get to the point where we can have a comfortable retirement and where we can have enough money set aside so that it will last as long as we last. It will last until the time of our death. But as I've worked with clients over the years, I've also discovered I often ask to take a look at their will to find out what they hope to do with their money when they're gone. And many times you will see a charity or multiple charities named in a will. And I always thought, before I got into financial planning, I always thought, well, that's the way you're supposed to be charitable. You know, you accumulate wealth and then you have a lawyer prepare your will, and you leave some of your money, some of the leftovers, if you will, to charitable institutions that you value. And so people have this desire to have enough to function until they die, and then they often want to leave a legacy through the will to the charities that they value. Well, the charitable vehicles that we're going to talk about today allow you to address both of those issues and achieve both of them at the same time. In addition, I guess my philosophy has changed a little bit from and has moved away from leaving charities money in a will. I still think that that's doable. On the other hand, I don't get any joy out of giving when I'm dead. There's a joy in giving while you're alive, and frankly, it's a lot more fun to and gives you a lot more satisfaction to be able to give the money while you're alive, and while you can have a say in a real say in where the money goes. In addition, there's another reason why it's advisable I'll say to give ahead. And if you're doing a good job with your financial planner, you are passing along most of your assets not through your will, but through beneficiary designations. And what happens when you pass along most of your assets through beneficiary designations is that the amount of your estate is reduced. And a lot of people, when they do giving through a will say, well, I want, let's say, 10% of my assets to go to a charity. Well, if you've passed along most of your assets through beneficiary designations, there's not going to be a whole lot left to pass along to a charity. So using various kinds of charitable gifting instruments can allow you to make sure that the charities that you are excited about and that you want to see continue in the future, to make sure that they benefit from all these assets that you've accumulated over the years.
That's helpful, Dick. And I know from talking to my colleagues here, that's one of the fear of the unknown is one of the questions that often come up when we start talking about an income producing way of giving, is that none of us know what the future holds. None of us know how long we're going to be around. It's still nice to be able to make a commitment to give while you're alive and benefit from like you said, the excitement, the good feelings about that, knowing where it's going to go. And the two instruments that we deal with the most tend to be the gift annuity and what we call the CRUT, or the Charitable Remainder Unit Trust. So maybe you could talk to us about some of the similarities and then some of the fundamental differences between these two forms of giving that both produce income.
Sure, and I'm gonna actually divide it up into three categories, and I explain the difference between those as we go. The three types of life income gifts that we're talking about here are the charitable gift annuity, and then two types of charitable remainder trusts. The charitable remainder annuity trust, which is referred to as a CRAT, and then the charitable remainder unit trust, which is the CRUT. So if you can keep those all those acronyms straight, and if you can't, doesn't matter. We'll figure that out along the way. All three of them do somewhat the same thing. That is, they all provide an income stream but they do it in slightly different ways and with slightly different rules. In each case, the remainder or the assets that are still in existence at the time of a person's death, that's what goes to the charity. So let's start with the easy one. That's the charitable gift annuity. And this is the one that I have worked with, I guess, the most clients on. One, because it's simple and seems to fit what they want to do, but there might be cases where the others would be a better fit. In the case of a charitable gift annuity, you give the charity a sum of money, let's say $25,000, and I'll use that because I think that's Houghton's minimum for a charitable gift annuity. And in return for that gift of $25,000, the charity would agree to pay you a certain percentage of that. Let's say might be 5 or 6% or somewhere in that range, and that percentage is based upon really two things. The current level of interest rates has an effect on it, but more importantly, life expectancy. So the later you start it, the higher the percentage. The earlier you start it, the lower the percentage. So if it was 6%, let's say, you would receive 6% of the $25,000 every year as long as you're alive. And at the time of your death or your beneficiary's death, the money, the remainder goes to the charity. The advantage to the charitable gift annuity is that it can be one life or two lives. So it often works well for a husband and a wife. You don't know who's going to die first in those cases. So you do a two-life charitable annuity, and as long as one person is alive, the payments continue. You also receive an immediate tax deduction for a portion of the gift at the time of the gift, not the entire $25,000. Again, the college or the charity that you're working with can do an analysis and show you exactly what it's going to produce. On average, the charity ends up with about half of the initial gift. So keep that in mind when you're making the gift. The charity is not likely to end up with the entire $25,000 unless you die early. And at least my experience with, I've served on the investment committee at the college for a number of years. And it always seemed like people that bought charitable gift annuities from Houghton always lived well beyond what was normal. I can't say that that'll be the situation or offer that as a reason to do it, but that always seemed to be the consequence. So that's the charitable gift annuity. Then next, let me just mention the charitable remainder annuity trust. Very similar. Again, you make a gift and receive a tax deduction in return for a fixed percentage, which you agree on, and that's based on the initial fair market value of the gift. So if you agreed that you wanted 5% and the charity agreed that 5% was appropriate, actually I believe 5% is the minimum that's permitted for this type of gift. So if everybody agreed on 5%, you would receive 5% of the initial fair market value of the gift for the rest of your life. Now, why would you want to do this rather than the charitable gift annuity? Well, it's With a charitable remainder annuity trust, it's possible to name multiple beneficiaries in addition, including non-spousal beneficiaries. The one downside to it is that you cannot make additional contributions. So you make the gift, and in a sense, you make the gift and you're done. The college or the charity pays you the agreed upon percentage, and that amount never changes for the life of the annuity trust. The charitable remainder unit trust is more flexible. Here, the income you will receive or that you receive will fluctuate based upon the value of the trust. So if you understand anything about the stock market, you know that the investments are changing every year. Now you have to remember that the market isn't always going to behave like it has the last 3 years. It doesn't always go up. So you can make a charitable remainder unit trust gift and you fix the percentage that you're going to receive, but that percentage, while it's likely to grow over time, it could go down on occasion if there are market fluctuations. So there's the potential for growth, but you need to be prepared for getting a little bit less. Just as with the annuity trust, you can have multiple beneficiaries, including non-spousal beneficiaries, other charities, so the money can get divided up between multiple charities at the time of your death. The advantage over the annuity trust, in addition to the potential for extra earnings or additional income, is that you can make additional contributions. So as you age, and again, we're going back to this idea of the fear of running out. If when you're starting out, you may not want to have as much money tied up, but as you age, you may say, well, okay, I can put a little more in, and maybe I need a little more income. You can add to that unit trust if you'd like to do that. So I'll stop there, Dan, and either entertain some questions or we can move on to your next question.
Yeah, sure. And I would mention as well that one of the things that it's relatively easy for us to do in the advancement here at Houghton is to provide you with an illustration. So if you were interested in doing an annuity or a children remainder unit trust or a vehicle like that, we can provide you with a basic illustration that would show you what's taxable coming in, what's taxable in terms of the income that you're receiving. And that was going to be my next question, Dick, in kind of a ballpark sense. What are the tax advantages of this kind of giving? And then also, what can the source of funding be for this type of giving as well? Are there limitations to where you can get the funds from to create an annuity or to create one of these types of trusts?
Yeah, well, before we get into the specifics of those things, let me just add that I think getting an illustration is very important so that you can sit down with your financial planner or your estate planner or your legal counsel or your accountant or tax preparer and see how's this going to affect me. I think you also have to ask the question, how do you want to benefit the charity? How big a gift are you able to make? And what income needs or desires do you have? These are all things that that are part of your, I'll call them part of your retirement plan or part of your estate plan that need to go into making a decision like this, because you're making a decision. Understand, you're making a decision that's not reversible. You can't 3 years from now say, "Oh boy, I shouldn't have done that," and go back, and you don't get a do-over with this kind of stuff. So it needs to be a very thoughtful consideration, and you need to think about, who, especially with the CRAT or the CRUT. What about the other beneficiaries? Who do you want? Who needs to be a beneficiary? But a big part of all of these decisions is going to be, what are the tax implications? Which approach has the greatest tax benefit? And to some extent, that's going to depend on your funding source, which we'll talk about in a minute. But you're going to, in every case, you're going to get an immediate tax deduction or immediate tax avoidance. Now, on the tax deduction side, things have changed in recent years a bit. When the IRS increased the standard deduction, which made charitable giving a little bit more challenging for people that don't give huge amounts of money. So, just getting a small charitable gift doesn't really help you from a tax standpoint. And so if you're inclined to do these somewhat larger gifts, then that's where you sit down with your planners and say, okay, what's the best way to pull this off so I get the maximum tax deduction, or I avoid the taxes that I would otherwise pay. So you may eliminate capital gains tax. The other reason to do this that might not be as obvious to a lot of people has to do with the Medicare portion of your Social Security that goes to pay for Medicare premiums. Now that's deducted when you're on Social Security. Your Medicare insurance premium gets taken out immediately. But if you get bumped into a higher tax bracket, you can also end up paying a higher Medicare insurance premium. So, for instance, if you cashed out of a big investment and had a huge amount of income in 1 year, that could force you into a higher tax bracket and also force you to pay higher Medicare insurance premiums. So you can avoid that by making a charitable gift, having the money go directly to the charity, and you receive just the income rather than all this boatload of cash from the sale of an asset, such as appreciated stocks or an appreciated business. You also have the potential to reduce or eliminate estate taxes depending on the total amount of assets that you have. You have the potential to protect assets from creditors, including protecting assets from nursing homes. If you are unfortunate enough to end up there for a period of time. And you can also overall receive more income than if you had sold the asset yourself. So you've got to look at both the short-term and the long-term tax benefits, again, with your advisors, unless you're good enough to do that on your own. Now, you also asked the question about, what kind of assets do we use to do this? And let me start by talking about what you don't want to use. You first of all don't want to say, well, I think I've got some money in an IRA, and I will transfer that to the college or to a charity in return for one of these life income gifts. You can't do that. You can make a contribution directly from an IRA to a charity, and that's a great thing to do. And we've already had some Ask the Expert sessions on that. So if that's something that you're inclined to do, there are some really good reasons to take that approach. But you can't use that money to, in a sense, purchase a life income or to make a life income gift and avoid the tax. You could do it, but you'd have to take the money out of your IRA, pay the ordinary income tax on that, and then make the gift. And that's simply not a tax efficient way to do that. You also wouldn't want to use money that's in a Roth IRA. It just doesn't make sense to do giving out of a Roth IRA, since that money grows tax-free and withdrawals are never taxed. So the best option for a life income gift of some kind is to use appreciated assets on which you would pay capital gains tax. And that could be stocks or other kinds of marketable investments, or it could be some other income producing asset such as real estate or closely held stock in a business of some kind that is a business other than an S corporation. You can't have money in an S corporation and use that to fund a life income gift.
Thanks,
So
Dick.
again,
That's helpful.
I'll stop there. And
A question that occurs to me, or a couple of things, and I invite members of my team to jump in as well. You mentioned the minimum amount to create a charitable gift annuity through Houghton College. Our policies dictate $25,000. That is correct, Dick. The minimum amount for creating a CRUD, a charitable remainder unit trust, through Houghton College is $150,000. And one of the things you had alluded to was the ability to name multiple beneficiaries. If that trust is created through Houghton College, our policies dictate that the sole beneficiary would have to be Houghton College. But you can use a third party, a community foundation, a denominational foundation, etc., to create a CRUT, which names Houghton College as one of the beneficiaries. And we have folks who let us know when they in fact do that. Am I leaving out any other detail there that just to kind of fill in some of the gaps?
No, I think that's helpful, Carl. And yeah, as we are open up for questions now. If those of you, as you're thinking about those questions, we have a couple more team members here that I want to have introduce themselves. Ben and Wayne are both here with us, and I'll let you introduce yourselves and talk about your role at Houghton.
I have to unmute myself. I figured out how to do it. Congratulations. So I'm Ben Coulter. Was an alum years ago. I still am an alum. Was a student years ago. I work with the team visiting with donors. I do a lot of work on the phone and through social media, connect with people as well. So some on the road, some here. I think my dubious honor is I get to call more alumni than anybody else at the college. So as long as my hearing's good, I'm in good shape.
Good afternoon, everyone. Let me first check to see if you're able to hear me. I don't have the best internet connection. Great. So I'm Wayne Lewis. I'm president of Houghton College. I've had the privilege of serving at Houghton for the last 7 months. It's actually 7 months this week, and it has been a tremendous honor and a joy to serve at this college and in this community. Thank you for joining us for this conversation this afternoon. I'm really already learning a lot from Dr. Hallberg, and look forward to having the opportunity to engage with those of you I haven't had the privilege of meeting yet. So thank you all.
Thanks, Ben. Thanks, President Lewis. So yeah, feel free. What other questions are coming to mind?
One of the things that might be helpful is, Dick alluded to a range of rates and depending on life expectancy. So we actually ascribe to the American Council on Gift Annuities on a regular basis to produce or provide to us what rates we should consider, and that those are the rates that we utilize. And so sometimes there are advantages to getting older. I like to tell people the older you are, the lower your life expectancy, the higher the interest rate is. So Caleb Smith, who works with our legacy donors, is the one that puts together those detailed illustrations that we can print and snail mail to you or put into a PDF and email to you, but breaks down the specific tax implications, but also based on the ages. So Caleb, I thought it might be helpful to share with people, kind of an age range, maybe in 5-year gaps currently, what the interest rates would be for a gift annuity, and then maybe contrast that with one life versus 2 lives.
Absolutely, yeah. So for a single life annuity for obviously $25,000, at age 65, you're looking at a payout rate of about 4.2%. At 70, you're looking at 4.7, and at 75, it gets more into the range that Dick was talking about, which is 5.4%. At 80, 6.5. At 85, it goes up to 7.6, and then finally 90 is 8.6. When you contrast that with a dual life annuity, you see a slight reduction. So just as an example, at 70, with a 4.7% payout rate, a 2 life would then be a 4.2. So we go 4.7 single, 4.2 dual.
So
I might add in that respect that since I've lived a little bit longer than most of the people in the room today, when interest rates were exceedingly high, those projections were better than they are now. We are in a very, as everybody knows, we're in a very low interest rate environment, and that has affected the recommended payouts. So as the Fed increases, if you're, depending on your age now, if you're looking ahead to, okay, this is something that I'm going to do 10 years from now, those interest rates may change depending upon the circumstances. The other thing that I've always liked about the fact that virtually every charitable organization uses the same tables, so it's not like you need to jump around from one charity to another searching for the best deal. As Carl mentioned, if you want to give to multiple charities, you can't do it through Houghton, through a Houghton unit trust, but you might be able to set up a situation with another organization where Houghton would benefit in the end if you wanted to do the multiple charity thing. You know, or you can do you can have more than one unit trust, one with Houghton and one with another charity that you support. You know, the more the merrier. The most important thing is what are your circumstances? Again, what are you trying to accomplish? What are your income needs? And how do you want the charity to benefit? So, you know, it's a dual purpose here.
Yeah, I love the fact, Dick, that you talked about what are your goals? What are your objectives? And as we talk with donors, that's what we try to get to the heart of, right? What are you trying to accomplish in your lifetime and through your legacy? And one of the reasons that you would land on, one of the obvious reasons you would land on why a life income gift is because you believe that you need additional income between now and the time that God calls you home. That's one of the primary reasons that you would consider. If that's not something that you need or want, then this is not the type of planned gift that you would hope for. I love the fact that you talked about enjoying the blessings and the joy of giving now, as opposed to when you're already in heaven. When we talk to people and they say, yeah, I would like to do this through my estate plan. I'd like to create a scholarship that's going to benefit education students. Well, the reality is, if you have the resources now is the great time, because you get to see firsthand the students who receive those scholarships year over year and the blessings that come with it. And so if you don't need the income, don't consider a life income gift. Consider an outright gift. That would be our advice if you're so inclined.
And I would, in that respect, Carl, I would again go back to what I mentioned briefly earlier. You know, for people that are beyond 70 and a half, as far as I'm concerned, from a financial planning standpoint, the absolute best possible way to make charitable gifts is from an IRA. Because then you avoid the tax entirely, and furthermore, you can, you know, if you've put aside a fair amount of money for retirement, then there's going to be a substantial amount of money that you're going to be forced to pay taxes on by the government. And you're going to have to do it annually. And if you can make a decision sort of 1 year at a time, that, okay, this year I need the money, maybe or I need half of the money. Next year, I need all of it, or maybe I don't need any of it. And so your gifts can change as your plans change, because in the financial planning world, nothing is static, and you don't know what tomorrow holds, or what your circumstances might be 5 years from now. I guess I would also add, if you have money that is in a 401k or a 403b, you need to talk to your planner or somebody else about shifting that money, doing a direct rollover to an IRA, because then you have maximum flexibility. You cannot make charitable gifts from a 401k or a 403b. And for that reason, I don't like those instruments. But it's easy to do a direct rollover to an IRA and accomplish the same thing, but you provide yourself with the option of doing charitable giving from that account.
And I think it's probably safe to say, I know John Oden's on the call here too, but that might be the fastest growing form of giving that we're seeing right now is individuals giving from their RMD for their IRA. So it's been wonderful for people to be able to see a tax advantage to that. And of course, the primary reason they want to do it, they want to benefit Houghton, they want to make a gift, and they can see this is the best tax advantaged way to do that. And he's nodding, so I think he's in agreement. Yeah, I would encourage, yeah, anyone with a question. I mean, those of us who are, the longer we do this, the more stories that we collect, more individuals that we've worked with, and help them take information to their financial planners. And then, of course, the part two is the real fun part, and that's how do you want these dollars to impact Houghton College? Where is your heart? Endowed scholarship, wherever, you know, unrestricted. And so we've all had the privilege of working with donors who have created endowments, sometimes in part through what they give now, and then also through their estate, or through these income producing gifts like different kinds of trusts and multiple gift annuities sometimes for individuals too.
John knows our policies and procedures better than anyone. One of the things I haven't heard stated, I don't think, is can you use the residual from your annuity or trust and designate that for something very specifically at Houghton? And how do you do that, John?
Yes, you would do it when you set up your gift annuity or charitable remainder unit trust with Houghton. You would designate your gift at that time. Many people will designate them for, say, an endowed scholarship. It could even be an endowed scholarship that doesn't currently exist today. And we would complete an agreement of endowment. We'd have all the paperwork in place. And when that person passes and then Houghton receives the final residuum of the gift, it would go into that endowed fund and be spent for the purpose set up at the time of the agreement of endowment.
The other thing we've talked about the minimum amounts, 25,000 for a gift annuity and 150,000 for a CRUT. Is there a ceiling?
There's definitely no ceiling for a CRUT. That could be as high as anybody wanted it to be. I believe that our controller and CFO would want to talk about any gift annuity that probably exceeded $500,000 or more, just because they wouldn't want one gift annuity to dominate the entire pool, based on conversations I've had with them in the past. But that would be up for conversation at the time. And at $500,000, you could do a charitable remainder annuity trust if you were looking for that type of gift anyway.
Yeah. So John, how do we manage, how do we invest, and who do we utilize to manage our investments related to gift annuities and trusts?
So we utilize KeyBank. They are well respected in the industry and they help us manage all of our annuities and trusts. They handle, actually, we send them the payments. So they process the payments, they manage the accounts, they send out the payments to donors for the income that's actually being sent out. They handle all of that for us. We do the illustrations and send those to them so that they can process them, but they really handle the bulk of the work. And then all of those investments are managed through the investment committee of the board.
Including tax documents, correct?
Yes, they handle all the tax documents. It's a nice arrangement for us.
If you didn't realize, one of the, from a timing perspective, why we chose to focus on gift annuities and trusts was, number one, the amount that we have been managing, the number of gift annuities that have been created has continued to grow over the course of years. And we just mailed out, for those of you who most of you, I hope, saw this, but our James S. Lucky Society newsletter, our most recent one, focused on why a charitable gift annuity, and we talked about some of the details related. One of the things that's in there is the states that we currently are licensed. So we have to be licensed in a particular state to offer charitable gift annuity. So Caleb or John, maybe which states are we in, and what are the potential workarounds as well?
So work for gift annuities, we're currently in New York, Michigan, Ohio, Pennsylvania, Virginia, South Carolina, Kentucky, Indiana, Minnesota, Arizona, and Texas. There's a few other states that we could potentially add by filling out some paperwork and working with the state's attorney general's office to get that completed. There's some states that we could probably never qualify for a variety of reasons, just based on the rules and regulations that the states have or the reporting requirements that we'd have to meet to be registered in that state. However, you could set up a gift annuity with a third party like a community foundation, as Carl noted, and have us be the beneficiary. Or if you could reach the minimum, we could do a charitable remainder unit trust in any state. We don't have the limitations with those that we do with the gift annuities.
I had a question for Dick. I was a little confused by one of his comments and appreciate it if he could clarify it for me. You mentioned about moving from a 403B to an IRA, that was something that you would advise doing. But then earlier you said don't use IRA money to set up any of these trusts, and I was confused by that.
Well, it's two different ways to give. You can, if you're using an IRA, for instance, to make the gift, the money goes from the IRA. You simply contact whoever holds the IRA and say, I would like to make a gift to Houghton College of X number of dollars, and they will take that out and mail it to the charity, and that counts towards your required minimum distribution for the year. What you can't do is contact your investment provider and say, I'm purchasing a charitable gift annuity from Houghton College, and I want to do it with money from my IRA and avoid the tax. That way you cannot avoid the tax. You would have to take the money out of the IRA, pay the tax at ordinary income rates, and then purchase the charitable gift annuity. And that's simply not a tax efficient way to do the charitable gift annuity. You know, so the primary purpose of the life income gifts that we've been talking about today are to be able to make a gift and receive life income. If you're giving out of your IRA, you're not doing it because you want any life income from it. Does that make sense, Ralph?
Well, yeah, it does. Thank you for clarifying that. What did you say earlier, that you cannot give directly out of a 403B?
No, you cannot, and you can't avoid the tax. You can say, I want to take money out of my 403B, but as soon as you take the money out, you're gonna pay the ordinary income tax on the withdrawal, and then you make the gift, which again is not a very tax efficient way to make the gift.
Right. If you move money from a 403B into an IRA, does that increase the required distribution?
No, it does not. It does not change your RMD at all. You use the same tables.
Okay, thank you.
I might also add, for those of you who are beyond 70 and a half and have to do RMDs, that as of January 1st, the RMD tables have changed. And the amount that you are required to withdraw has been reduced. So as you're getting ready to make your 2020 withdrawals, if you're a do-it-yourself type of planner, make sure you have the new tables, which actually are not officially published yet by the IRS.
Yeah, you talked about being tax efficient. So from an outright giving standpoint, the ability to give through your IRA beyond 70 and a half is the most tax advantage way to give. One of the things you alluded to, Dick, earlier is one of the options in order to fund an annuity or trust, again, from a tax advantage standpoint, is to utilize appreciated assets, appreciated securities. That, from our experience, is a great vehicle to utilize to fund these. And so I'll just, put an exclamation point on that statement that you made.
Yes, and especially if you're doing a life income, if you're doing a CRUT, and you had, let's say, $150,000 in stocks that you wanted to use to fund it, as soon as if you took that money out, that's obviously going to push you into a higher tax bracket, which it can complicate things in a variety of ways. So yeah, that makes that very attractive.
And the illustration that we would provide you would show you the tax benefit you would get by making the initial gift, and as well as the taxable nature of the payments that you would be receiving. And I would also mention, if you're thinking about using property or stock, make sure you have a conversation with us, because obviously you give the stock or the property directly to the college, and then the college then liquidates that asset. So if you sell the stock and then want to create a CRUT with it, then, as Dick said, the second that action happens, you're paying that tax. And it's the same thing. We have done these with real estate, for example. That's a longer conversation, but it is a process where the college has to take possession and sell the property in order to create the trust. And so that's something that we want to make sure we start talking about and get an illustration for, go to the gift acceptance policy, all those kind of things as well. But it is something that we've done.
When Caleb was talking about ages and the rates related to them, I'm not sure we actually stated out loud the minimum age in order to create a gift annuity through Houghton College is 65. So if you're not at age 65 yet, be patient with us. One of the other things I don't think has been talked about is the ability to defer a gift annuity and the opportunities that exist. So maybe you say, I'm going to create the gift annuity, but at age 70, but I'm going to defer actually receiving any of those payments, and maybe talk through that and what the implications are and the reasons why. John or Dick, you want to talk about that maybe?
So I believe you could actually even create a deferred gift annuity at the college. I think it's starting at age 60, 55 or 60. I don't have it right in front of me. That's deferred until you turn 65, and then you receive payments at that age. So the benefit is that you could make the gift today, even though you wouldn't have the payments till future time when you might more likely need them.
And I believe our policies allowed you to defer CRUT as well, starting at 60. If you wanted to delay payments and continue funding it, that's also another.
You can start a CRUT at 60.
Yeah.
It wouldn't be deferred. It would just be the starting age.
You could defer payments as well if you wanted to.
Yeah, and the other reason for deferring is because, perhaps you can benefit from making the gift now and getting the tax benefit now, but you have current income sources, and you don't need more income right now. You're going to need the income after you're retired, and so maybe you plan to retire at 70 or whenever, and so you want the income to kick in at that point, not currently.
So we are just about an hour in, which is great, into this conversation. What I would like to say is, number one, obviously the advancement office is available to you. If you know any of us, feel free to reach out to us directly with any questions that you might have. Again, we can provide the detailed illustrations and do our best. But I think, Dick, you did this before when you were part of Ask the Experts. You would also avail yourself if someone wanted to ask questions to you, and we can provide that contact information if you don't have it. But we so appreciate you providing your wisdom and experience and knowledge with us. So I'll just say, any last burning question that you might have that you want to ask before we draw this session to a close? Anyone?
Dick, if I could ask a question that's slightly off the mainstream of the conversation this afternoon. Could you comment on whether there's any tax advantage for a small business to make a contribution to a charity versus an individual making a contribution to a charity?
Well, it depends depends partly on the structure of the small business. Are you, is the small business a sole proprietorship? Is it a C Corp? Is it an S Corp?
LLC?
So I'm a little hesitant to answer that because I have not in the last couple of years worked with tax issues related to an LLC.
No problem.
That's a good question, but I don't want to say anything that's misleading.
That's fine. Thank you.
All right, Dan, any last thoughts here before we close up? And again, this is being recorded, and we will post this tomorrow.
Yeah, just to say thanks again to Dick for being willing to help us out and being such a great example of a Houghton College alum. And obviously you've drawn a lot of class of 71 folks here today, I'm noticing in our audience. So special welcome to all of you. And yeah, again, thanks for being here and asking questions. Please keep the conversation going. We're always happy to talk